All right, so what are your expectations for PPI today, CPI tomorrow? I think the question a lot of people are trying to figure out, are these market movers after we got that very soft jobs report, and we also saw the revision yesterday, signaling that there's a lot of weakness in the job market? We've also seen to get some signals from Jay Powell that the job market is more of a focus than inflation.
I think that's certainly the case. That's the message we've been getting. But nonetheless, the Fed does have to try to balance these two things out. So you imagine the most challenging scenario for them would be particularly if the CPI data came in higher than expected, because then they're really going to be faced quite directly with that dilemma, particularly if we see in the next CPI data more pressure on the goods front from tariffs. And it's worth remembering that if we go back to last month's CPI data, which was generally interpreted as a positive surprise, i.e. you didn't see that goods inflation. But if you looked at the detail, the reason for that is you had one sector that had significant disinflation, so that brought down that headline figure. If you strip that particular figure out, the number was much more unsettling. And if that's the number that we got this time, it really will be a challenge for the Fed to explain that balance, the pressure you're seeing on inflation on one hand, if that happens. But then we look at what's happening in the labor market, and you see certainly significant softness there.
Daniel, I want to move on. I don't want to dwell on this too much, but the estimate for CPI, the headline number is 2.9%. Now, we heard from Jay Powell that 2.9% seemed to be fine when it came to PCE. Do you believe that 2.9% headline CPI is also okay for the Fed to continue cutting rates? Just very quickly.
Yeah, I think it would be. I think we've probably focused more on the month-on-month number because that's where you would expect to see more directly what's happening on the tariffs. If the last I checked, the consensus was 0.3, which is the same as it was last month. So if we get that, that's what's baked in. The concern is that that monthly number, month-on-month number comes in higher.
All right, moving on. Looking at Oracle shares this morning, they're popping. Last time I checked, they were up just about 29%. Very strong numbers, also some pretty strong forward guidance. Does this really confirm that the AI trade is still, alive and well, and that the secular bull market that's been fueled by this AI trade can continue from here?
Well, certainly we see sentiment swinging back and forth on a fairly regular basis, so I have no doubt we'll be asking the question from the other side if we see a sell-off a week or so from now. In general, we're still believers. Our primary overweights are the U.S. equities and the NASDAQ in the U.S., and clearly AI is a key driver. And I think what we're looking at, people talk a lot about or are concerned about valuations for tech stocks. Now, I'm not talking about particular companies, but if you look at forward PEs for the NASDAQ, they're a bit above average, but not extremely. But then the critique is, well, those earnings estimates are excessive, since everyone pricing in or looking for their earnings are going to come through. But if you look at the trend of those earnings expectations, they're really not going up that much more quickly than normal. So for now, we think that earnings trend is sustainable. And then the multiple that you're putting on that earnings trend, we also don't see as too high.